You know how it is you really want to get your head around something complex, like what actually goes on in the world of accounting and auditing?
Mm-hmm.
But, well, the thought of just wading through endless rules and jargon, it feels overwhelming. You just want the key stuff
Right.
without the information overload.
Absolutely. And I think what often gets missed, especially in fields like accounting that seem so, black and white, is the huge role that people play, their decisions, their pressures.
Right.
And our sources today, they give us this really fascinating look at exactly that, the human side of audits.
Totally. We've got this collection of real-world cases here, and they really shine a light on the professional responsibilities, but also those tricky ethical spots people find themselves in.
Yeah.
Forget staring at spreadsheets for a minute. We're diving into the actual situations, the dilemmas people faced, often when things got really tough.
And these cases, like you said, they cover a lot of ground. You see these accounting-motivated transactions
Mm.
where the goal seems to be just making the numbers look better.
Mm.
But then you also have these almost everyday moments where individual accountants face really difficult choices just doing their jobs.
Exactly. So the mission for this deep dive, and if you're listening, you're already on board, is to pull out the crucial insights from all this material.
Get right to the heart of it.
Yeah, give you that shortcut to understanding the big challenges, the ethical side of things that really shape accounting and auditing today. Okay, so let's start unpacking this.
All right.
One of the first things that really jumps out is this idea of the human element, how central it is to whether audits work or, well, fail.
Yeah, and what's fascinating, one of the sources makes this strong point that audit failures, they often aren't about the tech failing.
Oh,
It's more often about, say, clients intentionally trying to subvert the process or sometimes auditors just not fulfilling their responsibilities.
That's kind of surprising, isn't it? You'd think now, with all the sophisticated software and data crunching.
Right. You'd think tech would solve it.
But these cases keep bringing us back to people, to decisions, actions, judgment calls.
Hmm. And the idea is if we look at where things went wrong before, maybe we get better at spotting those red flags.
Yeah, in our own work, or even just when looking at company financials.
Exactly. Understanding these human factors is just vital. Whether you're preparing the numbers, checking them, or using them to invest,
Right.
spotting those early signs can prevent much bigger issues later. And it's quite telling some cases even involve accounting students facing dilemmas.
Oh, yeah.
Yeah, it really grounds it, makes it relatable, especially for people maybe just starting out or thinking about the profession.
For sure. And speaking of dilemmas, these cases give us some really vivid examples, like cardio travel systems.
Mm-hmm.
We've got audit partners facing this choice.
Mm-hmm.
Do we accept what sounds like a pretty weak explanation from the client for something odd?
Or do you push?
Or do you push, insist on digging deeper, and potentially, open a whole can of worms?
That tension is always there, isn't it? Between trusting management and maintaining that professional skepticism, it's a judgment call.
Huge judgment call
Yeah.
with potentially massive consequences.
And it really hits at that core ethical responsibility. How much questioning is enough? When is it okay to take their word for it? And when do you absolutely have to push back, even if it causes friction?
Right.
Cardillo is a perfect example of trying to find that balance.
Then there's the Hamilton Wong case. It brings up this practice called eating time.
Ah, yes, underreporting hours.
Basically, yeah, not recording all the hours you actually worked on an audit. Seems maybe small, but the case argues it can seriously hit audit quality.
Oh, definitely.
And it just poisons the work environment for the whole team. Imagine if your colleague is doing that.
Yeah, think about the ripple effect. If time isn't reported right, you get rushed work, maybe steps get skipped, the audit isn't as thorough, and it creates this culture of pressure, maybe resentment too, if others are being honest about their time.
Right. And the Tommy O'Connell case is kind of related. A senior auditor suspects a staff member is signing off on work they haven't actually finished.
That's a serious breach. Signing off is supposed to mean you've done the work and checked it.
Exactly. A breach of trust, of responsibility. And this pressure just to sign off, to get things done even with doubts, it seems like a recurring theme.
It does pop up quite a bit.
Then there's a different angle in the Olivia Thomas case, office relationships. Dating within the audit firm.
Mm-hmm. Seems personal, right?
Totally seems personal. But the case explores how it could potentially compromise audit independence.
The appearance of bias, even if there isn't any actual bias.
Yeah, exactly. And it definitely complicates things personally and professionally. Can those relationships even create the appearance of a conflict? That's the key question for auditors.
It shows how our professional and personal ethics can get tangled up. Choices that feel private can impact professional judgment, or at least how it's perceived. And perception of independence is critical in auditing.
Absolutely critical. And the sources even touch on this duty to report illegal acts. If management knows about something illegal and won't report it to the SEC.
The auditor might have to.
Yeah, it poses that direct question. Where does the auditor's ultimate loyalty lie? Is it with the client paying the bills?
Or with the public interest, the integrity of the markets.
Right.
And that's really a cornerstone of the auditor's role, isn't it? Being a gatekeeper. The law, like the PSLRA, actually reinforces that obligation in certain situations.
Okay, let's maybe shift gears a bit. Let's dive into some of these accounting-motivated transactions. Stuff done more for the accounting result than for, actual business reasons.
Right. The Lehman Brothers case is, well, infamous for this, specifically those Repo 105 deals.
Repo 105, can you break that down a bit? What were they and why were they such a big deal?
Sure. So Repo 105s were technically short-term sales of securities. Lehman sold assets with a promise to buy them back very quickly, like overnight or in a few days.
Okay, sounds like a loan almost.
Normally, repo deals are treated like loans for accounting. But Lehman used a specific interpretation of the rules, SFAS 140 it was, to argue these were true sales. The key difference was how much collateral they posted. Because it was slightly over 105% of the cash received, they argued they'd given up effective control.
And treating it as a sale meant?
It meant they could temporarily take those assets and the related debt off their balance sheet right at the end of a reporting period.
Ah, so it made their leverage look better. Made them look less indebted, healthier.
Exactly. It improved their apparent financial condition, specifically that net leverage ratio everyone was watching.
But did it have a real business purpose beyond just making the numbers look good? The bankruptcy examiner seemed to think not.
Right. The examiner basically called them accounting tricks, designed to window dress the financials.
But Lehman's auditor, Ernst & Young, disagreed.
Well, E&Y defended the accounting. They argued it followed the rules, SFAS 140, as they interpreted them. It was a consequence of the rules, they said, not about the motive behind the transactions.
But didn't they decline to explain the business purpose when asked?
Reportedly, yes. Which is interesting. It brings up that huge question. Is just ticking the boxes on accounting rules enough?
Yeah. Or do auditors need to dig into the why, the economic substance?
That's the core debate. And the lawsuits that followed against E&Y really hinged on that interpretation of effective control under SFAS 140. Did Lehman really give it up? It leads straight to that question from the source material. Do auditors have a responsibility to figure out if transactions are mainly just accounting motivated? It challenges the whole scope of an audit.
It really does. Okay, moving on. This theme of intense pressure. It seems everywhere in these cases.
Yeah, it's a tough profession.
The Madison Wells case. Wow. An audit manager finds a mistake after the SEC filing, tells the partner, and gets verbally abused.
Yeah, it's an unsettling picture. It shows that high-stress environment.
Makes you wonder how often errors might get swept under the rug in that kind of atmosphere.
It certainly doesn't encourage people to speak up, does it? When the focus is just on hitting deadlines, sometimes professionalism can suffer.
And then below, this case talks about discretionary accruals and this push to nail the number.
Right. Accruals are estimates, and discretionary means management has some leeway in deciding the amount.
So they can be used to manage earnings.
Potentially, yes. And in below, there was this internal campaign, nail the number, pushing people to hit specific financial targets.
And the operating income jumped significantly.
It did. But the case suggests maybe it was artificially boosted by pushing those discretionary accruals, which raises doubts about how reliable those results really were.
That pressure to hit targets seems dangerous. And the Bankrate case, emails telling people to keep accounting adjustments under the radar.
Yeah, pretty blatant.
To meet targets given to the chairman. And even telling them to wrongly charge audit fees to an asset account to boost EBITDA.
That's just wrong accounting. It shows how the focus can shift completely from accurate reporting to just hitting a number any way you can.
It's a slippery slope.
A very slippery slope, often leading to much bigger problems.
And all this pressure, it can lead to auditors maybe not being skeptical enough, right? Oversight failures.
Absolutely. Look at the Just for Feet case.
Mm-hmm.
Deloitte, the auditors, they correctly identified vendor allowances and inventory as high-risk areas. That's good.
Okay.
But then you see this huge spike in receivables from vendors right at year-end.
Mm-hmm.
A big chunk lacked proper backup documentation. And crucially, the cash hadn't actually been collected months later when the audit work finished.
So multiple red flags waving frantically.
You'd think so. Despite spotting the risk, the follow-through seems questionable. Did they maintain enough professional skepticism when faced with those anomalies? A risk alert even pointed to this specific area needing scrutiny.
Wow. Then there's HMI, Health Management Inc., inventory fraud, and the new CFO finds it.
How? Through a casual conversation, just chatting with someone.
Seriously, not through, like, detailed audit tests.
Nope. Which kind of makes you wonder what the formal audit procedures might have missed over the years.
Yeah. It underscores the importance of just basic diligence.
Yeah.
Maybe asking the right questions.
And maybe a bit of luck sometimes. But the trial that followed, with BDO Seidman, that also showed the legal complexities auditors face when fraud happens. And that detail about the junior auditor trying an inventory roll-forward test, but then just discarding the results. No documentation.
Oof. In auditing, if it's not documented.
It didn't happen exactly. Big problem.
Okay, so let's talk about client management. Sometimes they're the ones driving the problems or even the fraud.
Oh, definitely. Lalonde Natures. That's a classic. The CEO, Podlucky, had absolute control.
No checks, no balances.
Pretty much none, which just paved the way for massive fraud. You had employees resigning, writing letters about terrible internal controls. And then, incredibly, a special committee investigation concludes no fraud. It just beggars belief.
How does that even happen?
It shows how critical strong corporate governance is. When one person has unchecked power, the risk just skyrockets. And that committee's finding. A stark reminder that investigations need to be truly independent and thorough.
And DHB Industries, similar pattern. David Brooks, absolute control, weak governance.
Intimidating the controller. And there was even this disagreement between the company and their auditors, Weiser LLP, about whether there were material weaknesses in internal controls.
The company said no. Auditors said yes.
Seems like it.
Yeah.
And when management pushes back hard against findings about weak controls, that itself is a huge red flag for auditors.
Definitely. And we can't talk fraud without mentioning ZZZ Best, Barry Minkow.
Oh, ZZZZ, legendary.
The sheer effort he went to. Millions to spend just to fool Ernst & Winnie about fake insurance restoration jobs, building fake sites.
It was incredibly elaborate, shows the lengths fraudsters will go to.
And didn't an informant report him initially?
Yes, but then Minkow apparently bribed the informant who then recanted their story.
Unbelievable.
It really highlights the challenge for auditors. How do you find something when someone is actively and expensively trying to deceive you? Even Alan Greenspan, questioned by Congress about it, felt like a victim of a really sophisticated scam.
It really brings home how vital communication and documentation are. We mentioned Hamilton Wong and eating time. That's a communication breakdown within the team.
Absolutely. Open, honest communication in the team is crucial. And the HMI case, with that discarded inventory test, documentation failure.
Right. If it's not written down, it doesn't count.
It's Audit 101.
And Cardillo Travel, again, executives lying to auditors, not keeping good records, that breaks the communication line with the client.
And fundamentally undermines the whole audit. If you can't rely on management's representations or the company's records, what can you rely on?
So inevitably, when things go wrong, there are consequences. Legal exposure.
We saw things like the Frank Coleman case, class action suits against big firms over alleged overtime violations, not even audit failure, but labor law stuff.
Shows the range of risks. And the PCAOB, the oversight board, they step in too, right? Yeah. Sanctions against Deloitte in the Legan Pharmaceuticals case.
Yeah, the PCAOB is the regulator for auditors of public companies. They investigate and enforce standards. Those sanctions are meant to be a deterrent, keep firms on their toes.
The Navistar case was wild, though. A client suing its auditor after almost a century, 98 years?
Yeah, Navistar sued Deloitte, alleging they were basically duped. And the PCAOB investigated, too.
Makes you wonder about those really long auditor-client relationships. Can you get too comfortable? Does skepticism fade?
It's a valid question. Does familiarity breed complacency? The case certainly highlights that potential tension.
And then there are those landmark legal cases that shape the profession. Ultramares.
Ah, yes. Justice Cardozo's ruling. Really important for defining who auditors can be held liable to, not just the client, but potentially third parties who rely on the audit report.
Like investors.
Exactly. And the first securities case, negligence charged against Ernst & Ernst because they didn't find a fraudulent internal rule, the mail rule. These cases set precedents for auditor responsibility and due care.
Okay, last big theme. Whistleblowing and internal reporting.
Mm-hmm. Crucial area. The Levent case is dramatic.
Yeah, accountants secretly meeting a KPMG partner.
Because they wanted to expose fraud by top execs, driven by this abusive and profane management style, as they put it, they felt they couldn't go through normal channels.
And later, someone described Deloitte's audits there as inadequate.
It shows the courage it takes to blow the whistle, especially in a toxic environment. And yeah, raises questions about why the audits didn't catch it sooner.
But whistleblower protections aren't always guaranteed, right? The Boeing case.
Right. That ruling said Sarbanes-Oxley protections didn't necessarily apply to internal auditors reporting concerns internally in that specific instance, an important nuance for people in those roles.
And Eva. Internal audit did find suspicious payments.
But proper FCPA Foreign Corrupt Practices Act training hadn't been done because of budget cuts.
Wow. Penny wise, pound foolish.
Exactly. Underscores the need to actually support internal controls and ethics programs, not just have them on paper. Training matters.
We even had that little epilogue for the Creve Coeur pizza case.
Yeah.
A CPA losing their license for revealing confidential client info.
Even though it might have involved tax evasion.
Right. Shows how strict those confidentiality rules are. It's a really fine line CPAs have to walk.
Absolutely. Upholding professional ethics, including confidentiality, is paramount, even when it feels like there's a competing public interest. It's a constant balancing act.
So, okay, wrapping up this deep dive, thinking about all these cases, a few themes just keep hammering home. How critical human judgment is. And ethics. It's not just about rules.
Definitely not just rules. It's about applying judgment in complex situations.
And the pressures are real, the conflicts are real, so that professional skepticism, auditors really need to hold on to it.
It's maybe their most important tool, especially when facing pressure from clients or even within their own firms.
And the consequences. When clients commit fraud or when audits fail, they're just huge for everyone involved.
Absolutely. These cases, they really show the complexity, the high stakes involved in trying to ensure financial reporting integrity. It's a massive responsibility.
So here's a final thought maybe to chew on. Looking at all this, what do you think are the biggest hurdles for auditors today? Staying independent, finding fraud when people are determined to hide it.
Yeah, those are huge.
And maybe what role does the broader business culture play? Does it foster ethical behavior or does it sometimes?
Not. Great question. How much does the overall environment enable or discourage ethical choices?
It really seems to boil down to that balance, doesn't it? Between the technical accounting rules and that messy, complicated, but absolutely crucial human element.